So today's Cardinal Lesson, we're going in depth into one of the tools that we use to create an income within the financial plan. We got lots of people coming to us. A lot of them have watched these YouTube videos and watched a series of them. And then they call us up. We're meeting them on Zoom. A lot of people just happen to be right around 65 because they're calling us about Medicare. Number of our people in their low 60s. We get people in their 70s. So we got a range in the 50s, 60s, and 70s, but the example we're using is around people 65. And we're showing you one of the tools we use to create an income. So I want to push it to Tom. Tom, why are we doing this video today?
Yeah, I mean, we're doing this video because I can't tell you the number of people who walk through our door that we're doing plans with that have been great savers, right? I really commend them. They were really diligent. They saved well. They get to retirement and now they're afraid to spend any of it. They don't want to touch it. They don't know how to spend it. And it's hard watching this because when you talk to them, it sounds like they're broke, but they have all this money they saved up. And so what we do as part of the financial planning process is come up with a way, show them how they can spend the money and not run the risk of running out, right? Because that's really at the heart of their fear is they don't want to spend it now because I might need it later. And this is a way, these tools are a way to get over that hurdle. And so let me bring up the show notes. You can find this at the link below our video. It's also on our website at cardinalguide.com. We have the board. It's the use of it. We're using annuities as the board. We'll get through the examples in a second. But in the show notes, we have all of them, sort of the actual proposals. So if you want to go look at them a little more closely, have at it. So I'm not going to spend a lot of time right now, but we have this first one. This is what produces the first 5 years of income. Hans will talk about that a little bit on the board. This is the example for a single tax filer because we have a single example and a married couple example. This is the single example. And then the next illustration here is the married couple here. So again, take a look at them. They're in the show notes. We'll give you all the numbers on the board. And then we have at the end of it, this gives you some guidance of kind of what the history of the 10-year treasury rate has been. This is important because a lot of these annuities and the payouts are subject to changes with these interest rate changes. It also gives you something to compare what the annuity is doing compared to what you might be able to do in like a treasury, for example. Just so you know, this chart was run on January 2nd. So as of January 2nd, 2026, the 10-year treasury is 4.18. When you're watching it, it might be slightly different now, but essentially this gives you the history of where that 10-year treasury has been. So let me turn it back to Hans. We'll get going on the board and we'll walk through the two examples here.
Okay, so when we do financial plans, one of the most important things we're going to do is we're going to come up with a number of income that's needed. And, it's spendable, already been taxed, net number that we're going to put in the financial plan is this is how much money we need. And we're going to need this amount of money for the rest of our lives. And we're going to have to put an inflation adjustment on that. And we're going to project, and really we're focusing on is the 80s and the 90s. I mean, if you're married, whether there's going to be two of you living through the 80s and 90s, and in a lot of situations, one of you is going to pass away and the other one's going to live on, then what's the income that's going to be needed by that single person and for how long? And none of us know when we're going to die. Only the good Lord knows that. And so in financial planning, we have to make estimates, but we need some level of insurance, and we can push this to an insurance company that if we live to a ripe old age, like 95 or 100 or 92 or something, we need to make sure that we're not out of money at that point, that we haven't spent it all in the 60s and the 70s and the 80s. And so people come to us with these fears. And a lot of them are just basically afraid to spend any of their money, any of their savings, when they're young for us in retirement in their 60s and 70s, when they can actually enjoy it, because they're afraid if they start spending it, all of a sudden we're going to have a bad stock market, or they're going to spend too much of it into some poor investments, and they're just afraid they're going to grow very old and run out of money. And so that's a fear. And so what we're talking about today is one of the tools that we use to shift some of this risk to an insurance company. So this is a lifetime income in units of $1,000 a month. So all the numbers on the board create $1,000 a month for life. So we can sit here and we run these numbers really quickly, sometimes during, but just right after we meet with the first meeting where we're getting people and we're looking at all their investments. So, and the 1,000 a month is the example that's here on this side of the board is for a couple. And the 1,000 a month is going to last for the life of two people. In other words, when the second one dies, that's when the income stops. So if we got this couple at 65 and one of them lives to 83 and the other one lives to 97, this 1,000 a month comes in till age 97. So that's shifting the risk to the insurance company. In this example, still 1,000 a month, but this is just one person age 65, and it doesn't matter whether it's a man or a woman, even though women have a longer life expectancy on average. These numbers are the same. And in the example, we have two annuities, and we've created the numbers to show you that between these two annuities, they're going to pay you $1,000 a month for the rest of your life, with the first $1,000 check coming 30 days from when this thing gets issued. So it's an immediate $1,000 a month, and it's lasting for an uncertain time, which is depending on either the last one of a couple to die or the single person passes away. So, and the reason we use two annuities is this second annuity that starts the 1,000 a month, that's not going to start until the end of 5 years or 60 months. It's going to start in the 61st month, where you're going to get a check for $1,000 a month. And once those checks start coming in, they don't stop till the second person dies. Well, what am I going to do for the first 60 months? That's where this $54,000 annuity comes in, is you put that to the insurance company, and that creates a cash flow of $1,000 a month for 60 months. So this one pays when this one runs out, this one starts, this one never runs out until you're passed away. So for one unit or $1,000 a month, the cost of that is $174,910 for the couple. So split between two annuities. For the single person, it's $163,000. It's obviously less because the insurance company has less risk. It only goes till that person passes away, and then the income stops. Now, the examples that we've shown down here at the board, we're showing you what the rate of return would have been at 85, 90, 95, and 100. This would be the death of the second person. And the same thing over here. If the second person lives to only 85, there is going to be no cash value left in either of these annuities. But let me talk first about what happens if you met an early death. So if both of you passed away at, let's say, 68 in an accident or something, and you just started this $1,000 a month on this one for 3 years, well, then your heirs or your beneficiaries would get the rest of the $1,000 a month for the remaining 2 years. That would be paid to them. On this second one, because the income hasn't started, the whole cash value of that plus some interest would be paid to the beneficiaries of this couple. Now let's look and say, what if death occurred at like 73? Both of you, again, were killed in an accident at 73, or one of you died at 69 and the other one passed away at 70. Doesn't really matter. This annuity would be expired. It would be all used up. But this one would have a pretty extensive cash value of the interest that it's earned over those years, minus the $1,000 payments. There would still be a pretty significant cash payment to your beneficiaries, because these $1,000 a month payments just dwindle down the principal till the principal's gone. And when we're showing the rates of return on these things, is the cash value of both of these annuities at 85 would be zero. So there is no death. If one of you lives to reasonably long age, there is no death benefit. you've just had the benefit of the $1,000 a month. Yeah, especially if you live to a ripe old age, your beneficiaries aren't going to get anything out of these things. But that's not the point. The point of them is people generally are afraid to spend some of their money. Okay. And if anything more than the interest, and then that's being eaten away. So, what we want to do in financial plans is take part of their money. So, I'm just showing you 1,000 a month. Most people, 1,000 a month isn't going to make that big of a difference. We don't sell many policies that pay out 1,000 a month, although I don't want to belittle it. So, in an example with a couple, if they needed 5,000 a month for life, we can look real quickly at the numbers, and we could come up with 174,910 times 5 equals 874,000 of their retirement money that we could put toward this, and they would buy 5,000 a month for the rest of their life. Okay. So I want to bring Tom on, and I want Tom to just react to some of this that I've gone over and possibly add something.
Yeah, I mean, I think when we're looking at doing a plan, right, we want to give you some examples on the video, but all of this is very specific to your situation, right? So this is not a recommendation for you specifically, but it gives you an idea of kind of what kind of money it would take to do that. For example, like if you're still working, that first annuity you might not need, right? Let's say we plan on working for another 5 years. We could just purchase the second annuity, not have to purchase the first one, and get the same result, right? So really, when we're doing planning, we're always sitting down looking at what your income needs are, what sources of income you have. I can think of plenty of examples where someone has a pension, they have Social Security, maybe both of them have pension, and they don't need something like this, right? Because there's not an income need there. And so now we're doing other stuff with them. So really what we're doing with these are trying to solve for a known income need that's not subject to market performance, right? Because one of the benefits of the annuities is it doesn't depend on what the stock market does, right? I mean, the last several years of the market have been great. But the problem is sitting here today is we don't know what the next 10, 15, 20 years look like. And so what we can do with this is guarantee the income, not have your income subject to market performance, and just have that go on into the future. So I think that's part of the reason it's built as part of that overall plan. It can be very useful. One of the reasons, and we'll get into sort of these rates of returns that Hans had mentioned, the real reason we look at these and we run these calculations is really because we're comparing this to the alternative, right? At the end of the day, if you're doing this, that means we're not doing something else. It's called opportunity cost. And we need to make sure that what we're recommending here is a good option for you. And so when we start looking at sort of an overall portfolio construction, how much stocks, how much bonds in your overall portfolio, these annuities are part of that bond allocation, right? So if a lot of retirees might be in a 60-40 portfolio, 60% equity, 40% bonds or fixed income. This annuity could replace some of those bonds. You start looking out 30 years from now, getting 5.7% return on a couple and a 6.3% on a single person. Those returns compared to what bonds are offering are quite attractive, right? And it produces the cash flow that you need to live on, not worrying about running out. And so I do want to show you just real quick. I'm not going to go through every example, but just kind of show you how we run these numbers. And we don't always show this to clients when we're doing them, because at the end of the day, it might not matter to them. But for us, it does matter, because we need to make sure that our recommendation is the best option for them. So I have an Excel file that I use all the time. And so we'll put in the single person first. So 163,420 of total premium going in. It gets across two annuities. It produces $1,000 a month of income, and it goes for 30 years. I kind of hit go, and the rate of return is 6.3%, right? If we do 25 years, which would get them to 90 as opposed to 95, you hit go, it's 5.6%, right? So I could go to 35 years, that's 100 years old, 6.8%. So again, you can look at how these rates of returns compare. Again, it does depend on how long you live, which is an unknown number. We don't know how long you're going to live, which is one of the beauties of the annuity, because if you do live a long life, the longer you live, the better return on the annuity you have. And a lot of people's fear is what's preventing them spending the money now is they're worried about outliving their money. They're worried they might live too long, and if they spend it now, it's not going to be there in the future. This annuity solves that. Just real quick, I'll do the example for a married couple. So it's 174,910 910 was the total premium. We'll do 30 years. Again, that puts them at 95, 5.7%. So again, when you're thinking about how these annuities compare to sort of not doing them, just keeping the money invested, compare these to the bond allocation as part of your portfolio. And the annuities, especially if we're planning for a long life, can be very attractive substitute for a portion of the bond allocation in your overall portfolio.
Okay, so I want to make some sense of these numbers. Like, why do we come up with these? Well, for starters, on the couples numbers here, both age 65, putting in $174,000, getting $1,000 a month, the cash flow yield is 6.86%. So, it's empowering them to spend almost 7% of their money every year without a fear of it running out, is another way to put it. But that yield is a bit deceptive because it's spending part of the principal every month. Okay, you just so it's not a true yield; it's just a cash flow percentage. But to our clients, a lot of them, it is a real number because they're just looking at the 12,000 a year, 1,000 a month, and maybe multiplying it times the number of thousands, and that's all they're looking at. We're looking at these numbers because we want to make sure that we're right in doing all our comparisons, and that this is truly, we're fiduciaries, that this is going to be the best option for them. Now, if you put this second person dying at 85, the yield is just 3.38%. But I want to point out something. That's net of any fees. I mean, that's a real yield. That's a net yield. And when we start comparing that, and most people that are in a 60-40 allocation are getting somewhere between 4 and 5% yield on their fixed income portion. But a lot of them are ignoring the fees that they're paying on that. And when we have money under management, we're charging 0.8% up to 1% of a fee on that. So that's going to lower that. This is a net number. And this is at age 85, but if you live just 5 years longer, this couple, the second one of the couple lived 5 years longer to age 90, it's 4.88% is the true yield that they got on this thing, and that's a net yield. And so the longer you live, the better this investment was for you. And again, this stuff doesn't matter to most people. All they know is they're getting checks for the rest of their life. Okay. Same over on the single person, but it's a little bit better because the cash flow yield is 7.34%. And these percentages are a little higher because it's betting on only on one life expectancy. And as I said earlier, if both of you are gone well short of 85, or this single person dies in their 70s or 60s, there's going to be a cash value in this second annuity that's going to go back. So we didn't calculate all those yields, but we could if people wanted to look at scenarios of showing them the true yields and the true payout. And again, we can only calculate that if we know when you're going to die. So this is just a for instance, and none of us knows that. Tom?
One thing I want to say one thing on these internal rate of return calculations, right? Some people they don't really. It's hard to understand what does this even really mean. So I'm gonna put it kind of a different way. And so essentially, what the internal rate of return is doing is saying how much of an investment would need to earn to be able to support the cash flow that we laid out. So if we look at age 95 for a married couple, and I had an investment that earned exactly 5.7038%. I could support, and that's without any changes. That's annually. That's what it's earning. I could support $1,000 a month of income based off that initial premium of 174. But if we had it outside of annuities at age 95, that investment would be done. Right, the money would be gone. It would be fully depleted. The ending balance would be zero. You get to 96, you have no more check. Right, so that's really where the benefit of the annuity is, because your life expectancy is unknown. We can't sit here and just solve for a known date because no one knows the day they're going to die. And so what the annuity does is able to produce that income. Yes, the longer you live, the higher the return is, but that's partly why you're buying it, is to protect against that long life, and not worry about running out. And so The other thing that the annuity does, so compared to just traditional investments, is it removes any uncertainty, right? It removes sequence of returns risk, which we have other videos on that. It removes market fluctuations, interest rate changes. It's all guaranteed from day one, right? So that is really the benefit of that. We're selling the annuities we sell, we're looking at the contractual guarantees they're offering, building it based off of that, not off the hypothetical growth of the annuities or anything like that. We're just looking at what is this company going to guarantee for the rest of your life, and we're going to try to get the highest return we can to get you the cash flow you need to live on and enjoy your money, right? Give your permission self to spend it, because the next month you got another check coming in, and the month after that, for the rest of your life, it's going to be coming in. One of the things that we would never put everyone's money in these annuities, some of the downsides to them, because everything in life has trade-offs, is this doesn't protect against inflation risk, right? Things get more expensive in the future. So you need to have other money invested in more traditional investments that are growing to offset that inflation risk, maybe buying another one of these at your start at a future date to help with that inflation option. So again, it needs to be part of a larger plan, but these are really great tools to allow yourself to spend some money that then's guaranteed to never run out.
Sure, there's lots of ways to deal with inflation, because remember that we're only talking about part of your money here. So we're not going to throw all the people's money in there. So there's lots of ways to deal with inflation. The performance of the rest of the equity portion of the portfolio is one of them. Another one is to buy another annuity that doesn't start till 75, and maybe another one that starts at 80. And those require a lot less money because the delayed starting, and then the insurance company can earn interest off of that money for all those years where you're not taking income, and then you're closer to the end of your life, or the end of both of your lives in case of a couple, when you start it. So those become much less expensive to put in there as an inflation hedge. So we're just trying to simplify this and give you some insight behind the scenes of what's going into these annuities. Another place is we have a number of clients that only buy this, the delayed 5 years annuity, or you actually could delay it longer than 5 years and you'd get more than $1,000 a month, and they don't buy this. I mean, the internal rate of return is just above 4 on this 54,000. Give us now and send me $1,000 a month for 60 months. It's not very it just looks, it's a very boring annuity. And some people say, well, I'll just deduct the $1,000 a month out of my investments and I can do better than this thing, but let me take the second annuity that I'm going to start at 70, and then I'm going to have the guarantee of that income for the rest of our lives. Okay, so this is just one example, and we're trying to go behind the scenes and show you on a couple and on a single person. And then I want to add a couple of points here. One is you can put IRA money into either of these. You can put Roth IRA money, and then the payments, $1,000 a month, is going to be tax-free. Or you can put non-qualified money, just money that you have in investments or in the bank. You can buy these. Both of these annuities will accept all three types of money. You also, on the second one, you can convert it all the way up to the time you start the income. So if somebody put $500,000 into this thing, for instance, and they started the income, that it's going to be pretty significant, when they're 70, they would have 5 years to convert it. They could do $100,000 a year for 5 years, and then by the end of the fifth year, that whole deposit will be Roth, and that way the income payments are going to be tax-free, and they're going to be tax-free for life. So there's a lot of things we can do with this. Another feature that's on this second annuity is the doubler feature for long-term care. I mean, that's an oversimplification. It's not long-term care insurance, but if either one of the couple, or the single in this case, if you need help with 2 of the 6 activities of daily living, in other words, you're similar to long-term care, that this $1,000 a month becomes $2,000 a month. It doubles, and it can stay doubled for up to 5 years. So there's some conditions on that. We have other videos about it. We'll talk later, but it's a feature that's just baked into this that'll supplement your long-term care insurance if that event happens to you. And then the final point that I wanted to make is we compare these yields to the yields you're getting on the fixed income. We'd made this earlier. We're not comparing these to yields and equities because we've removed the risk. We've removed the investment risk, the interest rate risk, and we've removed the longevity risk. So there's three risks that we're eliminating on part of your money. And so we're going to make the comparison to the fixed income portion of your portfolio and think about creating something with an income. Tom?
Yeah, I mean, I think it's a wonderful tool. It's not right for everybody, right? It needs to be part of a larger plan. But when people have a need for income, they're worried about spending, they're worried about outliving their money. This is a perfect type of setup that could really work for them and just give them freedom to enjoy their money, right? I mean, there's a lot of people that come in, have been great savers. They sacrificed earlier in their careers wisely to save for retirement. They get there and now they don't spend any of it, which again, it makes our job really easy, right? You're never going to run out, but ultimately you're sacrificing your lifestyle and not doing the things you maybe could afford to do because of fear of running out. And then also, so I mean, if that's it, then let's come up with a plan to leave it to the kids, right? And if that's not a priority, now we really need to talk, right? Because we need to get some clear goals of what you want to do with your money. Let's come up with a plan around that, right? So everyone's situation is different, everyone's recommendation is different, but ultimately you need to think through kind of what your goals are. Let's figure out the best way to do that. And this could be one of the tools to get there.
Okay. So within the scope of financial planning and the financial plans that we do for retirees or getting ready to get retired, we talked about Social Security in the sense is this money will add to your Social Security check. Your Social Security check is going to last as long as you're alive. Now you're going to have part of your investments or your savings or your retirement savings that's going to produce a monthly check that's going to last as long as the second one of you is alive. So this is sweet. Um, we didn't really talk about Medicare today. Long-term care, we touched on that. That's a piece of that, the doubler effect. The IRA 401k, I mean, frankly, most of these that people buy from us is using IRA money. This is that people retire and they got a bulk of money. Now they don't have their income coming in from their job. They maybe have their Social Security check. Maybe they're going to delay. Regardless, is we're going to create an income plan for them, which is the next box. And typically, we're going to use their IRA 401k to create a pension and turn it into that. Estate planning, a piece of this is depleting the estate over your lifetime for income purposes, but it has a beneficiary on it. And if you met an early death, there's going to be a death benefit on these, and we're going to direct that to the proper beneficiaries. And we haven't talked much about taxes, but it is really nice when we can do this with Roth money because that way we're creating a lifetime tax-free income. And we always have an attention to that. I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.